Episode 160 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risk and seize opportunities. Learn more at futuresfundamentals.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors, CME Group, Trading Technologies, and Top Step Trader. So without further ado, let's dial into those top moments of the show this month. All right, let's talk a little bit. We could go on all day with this. I want to talk about the stock market a little bit because it continues to make new highs, and there's always a story behind why we're making higher highs. Nobody ever could say hey, it's technically or it's fundamentally. It's just we just keep going up. But one of the big things right now is everyone's saying tax cuts, or that this is the market. The reason why the market continues to make new highs. What do you guys think about why? We'll start with you, Rick. Why the market continues to go high? Do you think it's tax cuts? Do you think it's technicals, or is there some other reason why you think it keeps going up?
Well, I think first of all we have to decide why it started to go up in the first place. Okay, so the bulk of the rally happened after the November 8th elections. I think that's key because we've seen a lot of legislation, this time around it's tax policy. Legislation is supposedly driving the market, repeal, replace, this or that. But as the policy would start as nice frozen ice cream and slowly melt away into a puddle on the floor, what did the market do? Kept going up. It doesn't fit the narrative that pretty much the media, let's be honest here, very few in the media have any respect for this president. But this isn't political. The market's up, not because of who won, in my opinion. I think the only theory that holds water is the market's up because of who didn't win. Okay? There's a status quo here. But, this is so not political. I really don't care. If politicians' lips are moving, they're all lying left, center, and right. But the reality is that the status quo that we had the last 2 years of the W administration and 8 years under the Barack Obama administration didn't have the kind of policies that are going to generate growth. What they did was they overspent, and they weren't bashful about it. The fact is that Hillary might have had the backing of Wall Street, and maybe she would have done some things that Wall Street liked. Let's be honest here. Wall Street's done really well the last 8 years. The too big to fail banks are getting bigger, and I don't suspect that's going to change anytime soon. But I think that the break in the status quo created a lottery ticket mentality in the eyes of investors. Okay? Merkel won, no big rallies. There's been a lot of big elections, didn't see any market movement. And that lotto ticket is that even if nothing gets done, what he wants to do may not get done, but what he's not going to do is he's not going to raise taxes, he's not going to put more regulations, he's not going to do a lot of things the market didn't like. And I think that's the only theory that holds water. Now, is the market getting excited about tax cuts? I think it is, and maybe that's part of the rally. But why do I feel convinced that even if this dwindles on and it doesn't get passed in 2017, I don't know that I see any tag days. And I think that the reason the stock market's rallying is a word that's misused. It's said so many times, but it's the teen effect. There is no alternative. You find somebody that doesn't like the stock market, okay? Fine, sell out your position. Then call the guy the next day. So what are you doing with your money? Where's he going to put it? Is he going to buy bonds? Okay. Do I want to be on the same trading card as the Federal Reserve at this point in the game? I don't think so. Commodities, maybe. But then you have foreign exchange issues. Central banks are piddling around with that as well. I don't know. I think that they created a lot of capital, and the capital is going to find a home, and digging a hole is as good as anything. But I think that the stock market underpinnings are part optimism that something's going to get done, and a lot of optimism about what didn't get done.
Ira, what do you think?
Well, I agree with a lot of what Rick says, but somebody asked me that question today, and I said, They said, is it Trump? I said, no, it's because he's taking credit for it. It's 90% still quantitative ease. We know.
Other central banks.
The European Central Bank is going to add a trillion in dollar terms, 720 euros, but basically a trillion. The Bank of Japan is going to add another $900 million. That's a lot of liquidity. We haven't even discussed the Swiss National Bank and other places. So there's so much, and money is fungible. You know, everybody forgets you live in a world. See, when Rick and I started out, there were actually foreign exchange controls. You couldn't just move money so easily around the world. Britain still had exchange controls. Money just flows, and most of you sitting in this room at a hit of a button. And it flows, and it flows, and it flows. So when the central banks are adding basically $2 trillion in liquidity, that's not, and the Fed is just rolling. They're just starting to shrink now, 10 billion. Okay. And they talk about the ECB possibly. We'll get to that later. But it all comes down to, it's all fungible. So, and it's got to go somewhere. It's got to go somewhere. And we know that economic growth, listen, for the amount of money the Fed has created in the system, we should be having economic growth nominal GDP of 8, 9, 10%. But it hasn't happened, which is why those people sitting in the Fed room are going, our models told us this was supposed to, but the models haven't projected.
Their models were right. It generated a lot of capital.
Oh,
it just, the model was wrong as to where it would go.
As to where it was, absolutely. And we live in a financially engineered economy. Everybody's trying to just generate, and the money's out there to do it. And especially if you don't need the money, it's there. You know, if you need to borrow money, borrowing money is not easy if you need it.
But I have to interrupt you, okay? I agree with that. You agree with me. But why did everything change on November 9th? Okay? The central banks didn't ramp anything up. They were still buying, what, combined $110 billion a month?
I agree with you. But what happened is that the fear of regulation. See, I think if Hillary had won, we would have had the next 4 years of more.
And I think that's why big banks were donating. Big banks love the barrier to entry. Build the wall higher so our competition can't even see who we are.
I agree with that wholeheartedly. So it's not that, and it's just that we're not getting the executive orders. Because what we don't realize, what we find out now, is how much regulation was created through all the different departments by executive order. And so business feels a little bit better. So it's that. And I think it's that with the money and the hope for tax cut. But as long as you ask me that, I'm going to respond to Buffett the other day. Because Becky Quick had him on, and I'm listening, and he says, he basically told you he'd like to be selling stocks here. He said that. But he doesn't because the tax cut. Now, personally, as an investor, and I own, throughout all of this, and my wife's sitting here, we own more stock than I ever have in my life. Because I have so much risk in my life, I don't need to, that's just not the way I operate. My savings is my savings, and we go from there. But we probably have more invested in stocks. And I've never understood trading stocks on a tax basis. My wife's a CPA. I'm not an accountant. My eyes glaze over. But Buffett's talking about, he doesn't want to sell now because of the corporate tax cut from 35 to 25 possibly. Well, wait a minute. That doesn't bother me. If I've had stocks for 2, 3, 4, 5 years, and if I sell out with a gain, I'm paying 20% long-term capital gains now. What is that 10% differential going to do for me personally? Minimus. Minimus. By the time it all falls out, if a company has 1 billion shares, what's going to be the real gain to me personally? And if everybody, and Buffett said he's holding out for that. He's holding out for that. So, I see the power in this rally, and I've long more stock in not in my trading account, that's a whole different world, but in my personal investing account, in my IRA, in my SEP account, in my wife and I, in our savings account, we have more stock than we have. But I'm a skeptic, but I also understand the power of this cheap money.
So what gets you to sell stock then?
Huh?
What's the catalyst to get you to start to sell some of that stock?
Well, Anthony, we've talked about this, and I know I enlightened you more than you knew about it. I'm a big yield curve guy. Yep. That's the one guarantee. all the wise asses in the world will tell you that, the stock market's predicted 10 of the last 6 recessions. Okay, I get that. But not the yield curves. Yield curves are absolutely beautiful. In 2007, the US 210 curve inverted. Most people don't realize that because the Fed was busy raising on the short end. Credit was out there. People were getting nervous. That curve inverted. The only thing I can't tell you, and there's a lot better mathematicians here sitting in this room than I am, I can't tell you the timeline of when that's going to take place because the market did rally another 4 or 5 months after the inversion. But the inversion was a signal. So I look for my signals. Yield curves are very important for me. When the European debt crisis of 2012 and Mario Draghi's famous comment of whatever it takes, and I actually was on with Steve Leisman that morning, July 25th, 2012, by happenstance. I drew the short straw for the 5:30 in the morning hit, and that's when he came out and said it. But Leisman and I were talking about it. He says, well, what's the problem here? The European yield curves were flattening dramatically because everybody was afraid of a solvency issue, not a liquidity issue, a solvency issue in Europe. And so they were actually running out of the 2-year notes. And if you looked at Italy, Spain, Portugal, even Germany, those curves, the 2-year yields were rising dramatically. They were up over 7%. So those curves had flattened, and that was the signal to me that something major was going on. So I look at yield curves. And right now, Rick and I have talked about it quite a bit because he's really, pay attention when he covers it because he knows this very well. But on the 210, and I have different ways of looking at it, but I'm using the 210 because that's more of an investor's curve. A 530 I view as a more speculative curve, but the 210, and if you look over the last 2 or 3 years, 73 basis points positive, which is still pretty rich. That's not flat by historical standards. If I asked you, I'll ask the audience, if I go over the last 200 months, 200 is quite a long time, what do you think the average of the 210 curve is?
The last how many months?
200 months. It's a long time, 20 years. Or it's about 95, 98 basis points. I haven't checked it, but so we're not really that flat for all the people we're talking about. I heard somebody talking about yesterday, oh, the bank stocks are up because the curves are steepening. Curves aren't steepening. The 210 today was at 86. It ended on December 31st. On December 31st, 2016, it was 131. So we're fairly flat here. The curve is flat, and it's not steepening, and yet bank stocks are a lot higher anyway. So when they try to sell you, that'll work at some point, but not necessarily. So the yield curves are very important for me.
Yeah, no, you definitely have enlightened me on that. You said the 210, 73 basis points. I continue to get asked about it on Twitter.
Times?
It just keeps hitting it and bouncing. So, hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. Hearing rumors that TT's entering the crypto space.
We don't respond to rumors and speculation, Anthony. No, so it's true. We're taking a measured approach, but I'm excited to report that Mike Unitich, who was my cousin, but also my co-founder at Ticket Trading Systems, and who joined me in the acquisition of our company to join TT 7 years ago now. He's actually been brought back to TT to help lead those efforts. And I think it's indicative that a trader who's as active and seasoned as Mike, wanting to come back and lead this effort is because traders like him, more and more, really over the last 6 to 12 months, have been coming to us saying, can you please bring your level of professional grade tooling, professional grade trading the crypto space, because the alternatives there really aren't alternatives. There's a lot of platforms, there's a lot of exchanges, none of which really let very, very active traders who want to trade large size do so with confidence. And so we will be, over the next few months, announcing more concrete details of that plan, but really providing market access to the cash crypto markets in a way that feels and works like a TT solution. Coupling that with our access to the global futures markets, something we think is going to be pretty exciting.
One of the biggest issues that traders, I think, also have, especially nowadays, is forcing to use a method, a system that used to work and they made money, and now it doesn't work. I mean, I've gone through this myself. I mean, it has been a transition every so many years, and this is my 18th year trading, that I'm always fighting what I just got done making money, and now I struggle to make money, and then now I have to learn how to make money again. I mean, it's the exciting part about this business, but it's also a big pain in the butt, because, you know, when you finally have some success and all of a sudden it stops working, it usually takes you a while to finally say, guess what, this may not work again, and then you have to start working on something else, and hopefully you've made enough money to exist long enough to make it through that transition. I know you want to say something, so go ahead.
Yeah, I was going to say perhaps it requires that, you be introspective and dispose of one of the beliefs underpinning one of the things that wasn't working. And so it kind of circles back to, like, I shouldn't say like, pardon me, do what works. That really should be the underlying principle, because ultimately the main goal of anyone's framework should be to find a reliable epistemology and do what works.
In my opinion, that's very easy to say, but in my experience, it's very hard to do.
Well, I suppose that's kind of like with trading precious metals this year. So I've had a fantastic time, or a fantastic little streak, if you will, selling highs and covering and buying lows, primarily because I think the regime hasn't changed yet. So I'm inclined to continue doing what works. And the historical probabilities of using that strategy have been pretty good, and the historical equity curve is pretty good. And so when that large downtrend line was being tested, 2 or 3 times, I think there were 2 or 3 false breakouts before the most recent one, which one might say has been somewhat successful. I maintained the whole time on Twitter and to other contacts that actually selling highs was the most reliable method, and so it kind of circles back to do what works.
Okay, quick question about the stock market and this relentless rally. Why do you think that the market is only looking at good news when it comes out and we continue to make new highs, but when bad news comes out, we have such a short-lived dip, if you even want to call it that, and it's immediately bought? Why do you think there are just really, let's call it what it is, there's really just no sellers out there?
The market is drunk on tax cuts. That to me, that is the sole explanation. Some people say, oh, well, we're up because of earnings. Well, in 2016, earnings growth was 0, and the market was up 10%. Earnings this year will be up about 10%, and the market's up north of 10%. So any earnings growth we're seeing, we've priced this multiple times over, and that's why the multiple is trading at around 20 times earnings on a trailing basis. This is all about tax reform and people doing the math of, okay, if the corporate tax rate goes from 35 down to 20 or 22, whatever, this is the boost to EPS, and they're buying stocks without doing really any more deeper analysis than that, because nothing happens in a vacuum. If the economy picks up, well, labor costs are going to pick up, and that happens to be the biggest part of a company's profit and loss statement. And interest rates are going higher, and lowered interest expense was a major contributor to earnings growth and elevated profit margins. And it will then accelerate Fed tightening, quantitative tightening, and Fed hiking of interest rates. So there's no broader thought to tax reform right now, but I think it's only the possibility of corporate tax rates going down. And like I said, the market is drunk on that. Reality will set in when people do a broader analysis of what this means for profit and loss statements. They'll also do a broader analysis of we're in the midst of quantitative tightening. Remember the party that was initiated each time the Fed did QE, and that now we're starting a shrinking of the balance sheet and the draining of liquidity, and it's like the market doesn't care. And yeah, they can say, well, the ECB is doing it and the Bank of Japan is doing it, but the Bank of Japan has been printing money on and off for 20 years. And the ECB is started a taper, and they're going to continue that taper. So that liquidity drip is going the opposite direction. And while there's still air going into that balloon, if there's less air going into the balloon, then the balloon starts to shrink, even though there's still air going in. At some point, people will pay attention to that, and that'll be the end of this bull market. But right now, like I said, they're drunk on tax cuts.
I want to move on and talk a little bit about market sentiment in bonds, currencies, and some commodities. Just give us a quick glimpse as to what you're looking at in some of those other asset classes.
I'll go through it.
Okay.
Bond sentiment on 9/7 hit 80%. It's currently at 43%. I think rates are at that 80%. You also had a downside DeMark exhaustion signal on the 10-year yield, and since then we're nearly we're 30 basis points higher, 935. So we've had quite a move, and the sentiment that I like to look at is interesting because it can go from the overbought to the oversold. And so at 43%, I think we could still go lower, and I think rates could go higher. So I'll keep going here. The euro on 9/8, it was at 93%. You also had an upside DeMark exhaustion around that same time frame, and currently the euro sentiment is at 47%. And you've seen the positioning on the commitment of traders. You had a lot of people super long euro, short the dollar. It's been a theme for the last couple quarters, and I think that's changing. So you're seeing a lot on all the major crosses with currencies, the same situation. The Canadian dollar hit 95% bulls on 9/7, and it's currently at 57. So that's moved down. The dollar bullish sentiment on 9/8 was at 7% bulls, and it just hit 66% yesterday. Now that's a really steep move, real quick, in 1 month. So there could be some consolidation there, but I do think that the dollar has the ability to move higher, and that would cause a lot of changes with the crosses, the major crosses. Going into some commodities, crude is currently at 58%. And that was that's been one that it got to 9% in the summer, and it's gradually moved higher. Crude hit 89% on 9/25, and it's backed off. So you had a real steep move off, more in Brent crude than West Texas. So you've had a better move, but still, I think that crude has the ability to perhaps stabilize and go a little higher. It's not a huge high conviction call, but I think that can happen. Let's go into gold. Gold is at 35%, up from a recent low of 25%. But then again, it hit 79% on 9/7. You had a lot of things happening around the first week of September. So 79 to 23 within a month. And you've seen what gold did. And I put out on Twitter and on the hedge fund telemetry note, showing the upside exhaustion signal, the DeMark exhaustion signal on gold, and I had so many people get upset with me. And gold moved up a little bit more right after the signal, and then it really collapsed. My favorite commodity right now is coffee on the long side, and it recently hit 16% bulls, and now it's 31. And I'm watching it right now as a as one that had a downside exhaustion signal recently on the daily and weekly time frame, and I think that's an interesting one to watch. It's one that could move a little bit more. Lumber, everybody's been buying lumber due to the hurricanes, there's huge demand, and that's 91% bulls right now, and that's been above 80% since 828. So since the hurricanes, you've really had lumber move up, and it stayed up here. And I currently have a DeMark signal. Let me just punch into Bloomberg here. Lumber. You have an exhaustion 13 today on lumber. So perhaps lumber is one that you want to sell short at this level. And the mechanical stop, lumber's at 410 right now. The mechanical stop would be 425. So this is what I like to see. I like to see different types of methodologies working in sync. So you have an upside exhaustion occurring with very high sentiment right now.
Okay, I want to talk about a couple of things here. First, I want to talk about the role of the Fed, and then we're going to talk about the debt burden, because you mentioned both. Another thing that I think that should be pretty simple is the role of the Fed, right? From reading so many blogs, I know it was founded by Congress in 1913. It was created to provide the nation with a safer, more flexible, and more stable monetary and financial system. Boy, have they taken on a bigger role than that, right? I mean, let's face it, it has gotten much bigger than that. And we are actually been having conversations on this show and a lot on you see in the media talking about, rolling back the balance sheet a little bit and how that's going to happen. So I want you to cover a couple of things. Is number one, the role of the Fed. Talk about how you see it, and if you think they've taken on too big of a role. I'm assuming you probably believe that, and what you think they should be doing going forward. And talk to us about debt. I mean, you mentioned it a lot. How is this all going to end? That's really what I want to know. You talked about how you were ahead of what was going to happen in 2008. Take us through and give us that vision as to what you think debt is going to cause the markets going forward.
The million-dollar question. I'll start with the Fed. The role of the Fed. The Fed was established as sort of the banker's bank, the backstop to the financial system. And I think over time, especially in the Greenspan era and Bernanke and now Yellen, they've gone from a passive Fed to a very aggressive Fed. And by aggressive, I mean they believe it's their job to steer the economy. What's very concerning about that is they seem to focus on half of the economy, on the demand and consumption side, with complete neglect for the supply side of the economy. And a healthy economy relies on supply and demand. Supply is where we work, where we produce, where we basically earn the means that allow us to create demand, to buy stuff. And when you put all your focus on one side, you get a very lopsided economy. So if you think about it, we've had all this growth, which I would say because some of it's fake growth due to the debt, that we now have a glut of supply because producers have been producing at a higher level than what should have been. And that's very deflationary, and we're seeing that right now. What should they be doing? I honestly think they should keep raising rates. I think lower rates have really they've obviously distorted the price of money, but because of that, it's resulted in misallocated capital that's chasing investments and projects that are not innovative, not productive. The money is not as easily going to those riskier items that really could be more productive and innovative. And we're seeing, I mean, it's very evident. You can see these distortions in valuations across so many markets. The $1 million question, how does it end? That's a great question. And I think the answer is the Fed won't let it end in a more traditional bankruptcy default type way. I think 2008 taught them that they need to be aggressive, and they can't let the dominoes start falling, because JP Morgan, Goldman Sachs were really threatening to their livelihood. And keep in mind, they own the Fed. The banks run the Fed. The banks get dividends from the Fed. So let's not pretend who their bosses are. But I think what this all means is more QE, more monetizing of the debt. At some point, it could be inflationary if the Fed decides to change the way they do QE. Right now, I believe that the way QE has been done largely benefits the capital markets. And that's done on purpose, both to help recapitalize the banks, but it's also done because the Fed believes in this wealth effect, where the wealthy make money in a market and then they spend the money. But that's been proven for the last 30 years that there really is no wealth effect. And we're seeing it now. The lopsided income inequality, wage inequality, that's how it's manifesting itself. But at the end of the day, I believe the Fed will continue to print. They may taper a little bit now. They may raise rates a little more. But at the end of the day, given the debt problem, it's hard to see how they can do much of that before they have to reverse and, in my opinion, do more QE.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.